All right, so it's speaking of the economy and spending money and everything else, let's talk about what is going on with the probably looming economic crisis in the next year or two. So we've been talking about this on and off for some time now, and we'll get right into it. This is from the AP. The Federal Reserve still foresees 3 interest rate cuts this year, despite a bump in inflation. We can read this article. This is, as I was saying in the intro, kind of a crazy subject to me because the market, investors, capitalists really, really desperately are used to the previous 10 years or so, which was a very low interest rate environment. You could borrow money at like less than 1% interest or less than 2% interest. And as the saying goes, anything is a viable business model at 1% interest. When they start bumping it up and it becomes more expensive to take on debt, the price of money goes up basically, and you're trying to refinance at like 7 or 8% when your debt comes up for, it expires and you have to renew it. A lot of businesses are not necessarily going to be able to do that. So they're desperate for the Fed to lower the interest rate so that they can get money more cheaply. And what's the problem? Is that this long period of low interest rates has created a huge amount of inflation. And I mean, it's a significant factor in inflation. It's not the only factor. But so you've got the inflation getting out of control, and they're trying to tame it down to the arbitrary 2% inflation level, which there's absolutely nothing like scientific about the 2% inflation rate. It was just literally like, somebody said, well, we should get inflation to 1%. I think it was an Australian authority. And somebody else was like, yeah, well, I don't know, maybe 2%. And that was about it. So anyway, they've settled on 2% inflation or 2% price growth from year to year. This is not prices ever falling, which they absolutely need to do. That would be deflation. But they're just like, well, we need to slow down the rate of inflation to 2%. That's their target. They think that is sustainable. It's really not. Prices have to come down. They can't just keep going up from here, even at a 2% rate. But anyway, the inflation is not under control yet. And yet they're already talking about caving to the demands of investors to lower the interest rate. And we've talked about, I did a big video on this before. And actually, let me go ahead and put this on the screen now. There we go. This is total assets. You can see what the banking system, the financial system has been doing in terms of quantitative easing and putting assets on the Fed's balance sheet. This is pretty much unprecedented on this level, but it's how they solved the problem of the 2008 global financial crisis. Is they started dumping lots and lots of money there, and also having higher requirements of keeping reserves for financial institutions and things like that. But it's gotten out of control. Every time that they try to bring it back down again, there's a financial major hiccup, let's say. And the only way that they can cure it, it's like that fever, it's only got one cure, more cowbell. This fever has only one cure, more quantitative easing. As soon as they try to do tightening, there's some event. Like you can see after a long period of the first 3 rounds of QE, in 2018 into 2019, they started backing off. And what happened? There was the repo madness event in late 2019 where the liquidity dried up and there was almost a major seizure of the financial system. Well, they eased their way back out of that. Then the pandemic hit and they did QE4, dumping huge amounts of money into the system. That peaked around 2022. Then they went back into quantitative tightening. But as they tightened, as they started pulling the money out of the system, what happened? Well, 1 year ago, you had the SVB, Silicon Valley Bank, and the Signature Bank crisis, and like Credit Suisse. And so you started having an event, and this happens like every time they just pull like 7 or 8% of the money they'd eased into the system. Well, after they tighten it back out, 7 or 8%, there's some kind of major event. So we've been in a tight, and then so look, how did they solve that? They took on those bad assets. Now they've been trying to tighten their way back out, and they're talking about doing quantitative easing again. But they're on the verge of risking hyperinflation at this point, like where things just cost, I mean, you hear the old stories about situations of hyperinflation, like, it costs like a wheelbarrow full of currency to like buy a loaf of bread. I mean, we're obviously not at that point, but prices are getting out of control. And definitely like housing is completely unaffordable. The median house price in the U.S. is over $400,000. You have to be making over $100,000 a year to be able to afford that. And that's, like 90%, like you have to be at the 90th percentile for income to afford a house, to afford the median house. So that's the situation that we're in. Of course, food is crazy expensive and so on. So going back to this, they are actually talking right now about cutting rates. And what they seem to be risking is the situation in the 70s where they cut rates too soon and inflation went way back up again. And it was just part of a larger crisis for the capitalist system in the 1970s, which was fixed in the 80s with Reaganism, Thatcherism, neoliberalism. So, in which they pushed the cost of the crisis onto workers. All right. So this is by Christopher Rugaber. I don't know. If that was my name, I'd say Rugaber. But yeah, March 20, 2024, AP. Federal Reserve officials signaled Wednesday, so this is a couple weeks ago, that they still expect to cut their key interest rate 3 times in 2024. And this fueled a rally on Wall Street, despite signs that inflation remained elevated at the start of the year. For now, the officials kept their benchmark rate unchanged for a 5th straight time. Now, keep in mind, they haven't cut anything yet. They're just saying that they expect to cut later, although there's some indications that they're less certain about that than they used to be. But they are still generally planning on it, okay? But how did Wall Street respond? They responded like they've already cut rates already. And it's so, anyway. Also, you need to kind of worry when they cut rates, because usually when they've cut rates, that means that they've done the damage and initiated a recession. So it's not actually like good news, because what they're trying to do is cause economic contraction. And why would they want economic contraction? Like, don't you want the economy to just grow? Well, we've been talking about this in the Fascism and Social Revolution audiobook that we just started recently. And no, capitalism, and this goes all the way back, you can read it in Principles of Communism, you can read it in the Manifesto of the Communist Party. It's been observed for a long time that capitalism has this 10-year cycle, or the boom and bust cycle, which is overproduction crises. It means that too much stuff gets produced, and production has to shut down for a while, economic activity has to contract, so that the extra commodity, the extra goods that have been produced, can be consumed. And then when scarcity has been reestablished, then production can resume. And so this is the boom and bust cycle. It's overproduction crises that have to be remedied by destruction of capital by one way or another. And in socialism, actually, you would not only not have this, but you would increase production dramatically beyond what capitalism, even in its best times, would do. Not only would you avoid the bust part of capitalism, but you would push way beyond where the boom is way bigger than it is in capitalism, because capitalism emerges during a time, feudalism, of natural scarcity. Capitalism then introduces huge productive forces that make it possible for, a few million people to do the work of what used to take like 1 billion people before. And so huge productive forces, natural scarcity is basically overcome. And then to protect profits and prices, capitalism has to artificially, by destroying capital and this whole cycle, they have to maintain artificial scarcity, basically. So this is one of the main ways that capitalism is holding back progress. Yes, it had a progressive role earlier over feudalism, but now it is literally holding us back and threatening to destroy all of human civilization and the environment and cause mass extinction and so on. Anyway, speaking at a news conference, Chair Jerome Powell said that the surprising pickup in inflation in January and February hadn't fundamentally changed the Fed's picture of the economy. The central bank still expects inflation to continue to cool, though more gradually than it thought 3 months ago. So it's changing its picture of that. Meanwhile, there's other economies that are going into flat-out recession, like Japan, the UK, Germany, Finland. And so it's like, well, there's a risk here that the U.S., they might do too much, and the U.S. unexpectedly slips into a huge recession. But anyway, it's so wild to me reading this stuff. It's like the people running the system don't even seem to know how it works. So anyway, the recent high inflation readings followed 6 months of steady slowdowns in price increases. Economists and Wall Street investors were looking for some more clarification Wednesday about how the latest inflation reports were viewed at the Fed. The January and February data, Powell said, quote, haven't really changed the overall story, which is that of inflation moving down gradually on a sometimes bumpy road toward 2%, which is the Fed's target, is for prices to increase 2% per year. Not to drop, but to increase, but only at that rate. In new quarterly projections that they issued, the policymakers forecast that stronger growth in inflation above their 2% target level would persist into next year. Overall, the forecasts suggest that the Fed still expects an unusual combination, a healthy job market and economy in tandem with inflation that continues to cool, just more gradually than they had predicted 3 months ago. So this is the soft landing or no landing scenario where they get things back under control and there's no, devastating disruption of society because of the economy. Good luck with that. They always predict it. It's rarely ever how it turns out. It turns out not that way more often than not. For this year, the Fed projected that the economy will expand 2.1%, a big increase from its December forecast of just 1.4%. Yet at the same time, it's still, that's 50% higher. Yet at the same time, it still expects inflation to keep declining, though slowly. Michael Gapin, chief U.S. economist at Bank of America, said that the Fed's updated projections suggest that it expects improvement in supply chains and availability of workers to continue, allowing the economy to grow even as inflation slows to the Fed's target. So they say availability of workers and supply chains. They're talking about the pandemic disruption, shutdowns, workers being sick en masse and things like that. They're expecting that that will be overcome. Well, we'll see. Rising immigration, for example, has made it easier for businesses to hire without having to rapidly raise pay. Quote, it looks to me like they're embracing that supply side story, Gapin said. That means you can cut while growth is solid and you can cut while the labor market is strong. Rate cuts would, over time, lead to lower costs for home and auto loans, credit card borrowing, and business loans. They might also aid President Joe Biden's re-election bid, which is facing widespread public unhappiness, or a 38% approval rating, over higher prices and could benefit from an economic jolt stemming from lower borrowing rates. This goes on a little bit. You can see a chart of inflation there. The financial markets cheered this message that they'll be cutting, and it's like inflation has come down. The cuts are just around the corner, and the market's like, cut now. And he's like, no, we're not going to cut now. I think he might kind of just be saying this, but we'll definitely see. And so it says the Fed's policymakers did make some small adjustment in their outlook. Their projections showed that in 2025, they now foresee only 3 rate cuts, down from the 4 they had earlier envisioned. One reason may be that they expect core inflation, which excludes volatile food and energy costs, to still be 2.6% by the end of 2024, which is up from their previous projection of 2.4 rather than 2.6. In January, core inflation was 2.8, according to the Fed's preferred measure. Oh, wow, we got a weird... that's really strange. There's a totally incomplete paragraph right there. So another interesting thing that I'd like to mention here is that Powell has been on record addressing the housing market. Just seeing if there's anything in here about that. They're talking about there's signs that the economy could weaken in the coming months. I think that that's likely. There's also they mentioned the unemployment rate. The unemployment rate has reached 3.9%, still a healthy level. Again, you don't need unemployment in socialism, but you need it in capitalism. So that's another thing we could overcome by ending capitalism is unemployment. But up from a half-century low last year of 3.4%. Thing you need to understand about unemployment is when it goes up, it tends to go up rapidly. It spikes. And this is another feature about the sort of stuck onset of the recession that we seem to be facing. So businesses seem to be very reluctant to, even though like manufacturing numbers are going down, like economic indicators are going down, yet they're not translating into layoffs. Why? Employers seem to right now be very reluctant to start laying people off, which that's one of the clearest and most obvious signs of a recession. It's in like most definitions of recession, like the top four indicators is unemployment going up. And but it hasn't yet in the US, and a lot of it may be related to in 2022 and so on, when businesses were having kind of a hard time hiring people. They want to keep the workers that they have now, even if there is an economic downturn and business starts slowing. They don't want to lose the workers and then not be able to hire them back later. And that's one explanation for why, even though there's a lot of economic indicators going south, one of the key ones that would formally signify a recession, unemployment, hasn't been moving yet. But there could be something eventually as businesses say, well, we're just losing too much money. I'd like to hold on to my workers, but we can't anymore. But they don't seem to have reached that point yet so much. Anyway, other major central banks are also keeping rates high to ensure that they have a firm handle on consumer price spikes. In Europe, pressures building to lower borrowing costs as inflation drops and economic growth stalls. And what's the next thing? Recession, which again, prices are insane. A recession would bring the prices down. But a lot of the people in the system, a lot of the capitalists right now, they're, I think, subconsciously like terrified of another 2008. And they're trying to forestall. They're like, no, keep interest rates low forever. We need to just keep everything afloat, no matter how kind of much of a distortion it is. And they really, really fear the next event because, as we were showing before on that housing chart, which is like a decent proxy in general, as we talk about more and more violent economic events as capitalism goes on, this is that housing prices adjusted for inflation over 130 years. I would call that definitely more and more violent fluctuations in prices that could, disrupt an entire society. They want to keep it high forever. No, it wants to come back down to the 130-year average. That's just what things do in capitalism. They eventually come back down to the average that it takes to produce stuff. But again, the instability, the gigantic fluctuations, they're trying to tell this story and tell themselves and go on believing that, no, it can just stay high forever. It doesn't have to come back down. And that's why they're begging for these rate cuts. But it will, and I think it's going to do another, 2008 when it does. So another story on this, Reuters. Fed's Powell says that balance sheet drawdown taper is coming soon. This is from about the same time 2 weeks ago. And this was crazy to me because I'm like, they're thinking about doing QE again. Like they're going to get rid of the quantitative tightening and start putting money back in or just level it out. So what does it say? Washington, March 20. The Federal Reserve is nearing a decision on slowing the pace of its balance sheet runoff. That's quantitative tightening. Central Bank Chair Jerome Powell said on Wednesday, a tapering move that may allow it to shed more bonds than it had once expected. Powell's remarks, the most explicit so far about plans to slow a process that has seen about $1.4 trillion of bonds roll off the Fed's balance sheet, was seen by several Wall Street analysts as a signal that a tapering plan will be unveiled as early as the Fed's next meeting on April 30 to May 1st. Quote, it will be appropriate to, or I've attempted to do a Powell impression, it'll be appropriate to slow the pace of runoff fairly soon. That wasn't a very good Powell, but he has this remarkable like text-to-speech voice. Anyway, said at a press conference following a federal open market committee meeting. He did not offer a specific time frame for the decision, saying only that officials are now debating the issue, whether to taper. Powell was addressing the central bank's ongoing efforts to reduce the size of its holdings, commonly referred to as quantitative tightening or QT. Officials aggressively increased the central bank's balance sheet as part of the response to the coronavirus pandemic. Starting in the spring of 2020, the Fed bought Treasury and mortgage bonds in great numbers, first to stabilize financial markets and then to provide stimulus when the Fed's interest rate target was at near zero levels and could be cut no further. So, in other words, what happened was they were giving away money that could be borrowed at 0% interest, basically. They couldn't cut the rate anymore because otherwise they'd be paying people to take loans out if you had a negative interest rate. So what did they start doing? They just started doing stimulus. They basically did start handing out free money or paying people to just exist. That quantitative easing, or QE, caused Fed holdings to more than double, topping out at $9 trillion by the summer of 2022. This is the chart we were looking at before. The Fed began to shrink the size of its holdings later that year, having embarked in March 2022 on what would be a robust campaign of interest rate increases aimed at bringing high levels of inflation back to its 2% target. And again, that 2% target is like totally arbitrary, as we discussed. So there's a chart, the evolution of the Fed's balance sheet, eyeing an end game for quantitative tightening. So this is the balance sheet size in dollars of how much the Federal Reserve is holding. But what do you notice? It starts in 2020, making the whole thing look kind of normal. But if we go back to the chart that I was showing before, which shows it on a longer time scale, yeah, so the 2020 part is just to the right of that rightmost gray line. If you go back, historically, prior to 2008 and that whole crisis, it was a much lower number. It was historically always under 1 trillion. And then what do we see? Are we seeing a breakdown crisis of capitalism and the world financial system here? They've never had to revert to this tactic before, and it's looking pretty serious there. Anyway, going back to what we had on the screen before, since the fall of 2022, the Fed has been allowing up to $60 billion per month in treasuries and $35 billion per month in mortgage bonds to expire and not be replaced. So in other words, those have expiration dates, and once they go, they are not replacing them with new ones. So overall, the balance is going down. The Fed is seeking to reduce the size of its holdings in a way that will ensure, note that confident language, ensure the financial system has enough liquidity or cash for the Fed to retain firm control over the federal funds rate, its chief tool to influence the economy's momentum and to allow for normal levels of volatility in money market rates. To achieve that, Fed officials have been signaling for some time that they would first lay out a plan to slow or taper the pace of quantitative tightening, given uncertainty over how far they'll need to shrink their overall holdings. But again, think back to that long-term chart. Where do they need to shrink it back to? Well, historically, it was always under 1 trillion. But now, what is special about this current period other than that it's, they're clinging to dear life after the 2008 to 2010 global financial crash? What is fundamentally different where suddenly it's oh yeah, 8 trillion or 7 trillion, it's somewhere in there. Well, why is it there now? And up to 2008, up to 15 years ago, it was always under 1 trillion. Why? And why can't you seem to get it back down again without major things breaking in the system? These are questions that they don't really want asked, or they don't have very good answers to. To me, it seems like a breakdown crisis of the system as it's reaching its global limits and its end of life limits. But anyway, officials are mindful of the events of September 2019. That was repo madness, when the repurchase markets started to seize up and go crazy. When a QT effort then in play, that was 2018 to 2019, they were starting to pull some of that money out of the system, unexpectedly drew too much liquidity out of the financial system. Although, again, it was 7 or 8% of what they had pumped in. Which, again, why was the system able to run without that before, but now taking 7 or 8% out causes another global economic meltdown? Riddle me this. Seriously, that is the question the system, I think, doesn't really want to answer. Anyway, causing significant interest rate churn, requiring the Fed to add liquidity back by once again expanding its balance sheet. And that's exactly what we saw on that. There's a little bump at the end of 2019, and then it spikes because of the pandemic. Thomas Simons, economist at investment bank Jefferies, said in a note that Powell's comments may have moved forward the start of the tapering process. Quote, "We had been thinking that the tapering of quantitative tightening would begin in June or July, but this guidance suggests that perhaps the announcement could come sooner, possibly the next meeting on May 1st, he wrote. Simon's view was echoed by others. Quote, "We now expect that the Fed may make this announcement as early as the May FOMC meeting, ahead of our previous expectation of a June announcement," Tiffany Wilding, managing director and economist at PIMCO, said in a note. In his press conference, Powell said that slowing the drawdown from its current pace may allow the central bank to compress the size of its holdings by a greater degree. Quote, "We may actually be able to get to a lower level because we would avoid the kind of frictions that might happen by shedding bonds too quickly," he said. Powell noted the end game for Fed holdings envisions a level of banking sector liquidity large enough to navigate normal volatility and periods of stress. But he cautioned that there's no easy rule of thumb for stopping QT, saying, quote, "There's not a dollar amount or percent of GDP or anything like that to look to. Why? This is a brand new technique that they started using like 15 years ago. Japan started using it a little bit earlier. There was, prior to 2008, there was the dot-com bubble and the crash of like 2001. I believe that Japan started using QE back then, and then it was more widely adopted globally after 2008. So, yeah, there's not a dollar amount or percent of GDP. Basically, they're going to start taking stuff out, but things could break at any time because they really don't know how dire the situation is, and this is kind of just a thing that they just made up. There's no real theory to it other than just get some money back in there so the system doesn't seize up. That's it. That's the only thing behind it. Just sheer panic, basically. Ahead of the FOMC meeting, a bare majority of economists in a Reuters poll had been expecting the QT taper process to begin in June and wrap up early next year. So, but again, wrap up early next year to what end? Like, what point of this graph are we going back to? Are we going back to pre-pandemic levels in a year and a half? That would involve cutting this by, like, in half. Is that even possible without the entire system just drying up like a raisin? I sincerely doubt it. So what are they considering the new normal for this? And how long will it last before another crisis breaks out anyway? Is there anything that they can do? I feel like we're at the end of the old 60s Batman. It's like, will the Cape Crusader be able to escape the Joker's, buzzsaw? I mean, it's like this cliffhanger thing of like, we're living through a gigantic crisis and nobody knows what the fuck is going to happen as far as 2008, the underlying issues of 2008 rearing its head again. So I got one more article for you here about this crisis, and that will end our economy section for this stream. But here's an article from The Conversation, Why Economists Are Warning of Another U.S. Banking Crisis. And this is from a little over a month ago, and that's Jay Powell himself there, the man with the beautiful monotone. March 2024 is making investors nervous. A major scheme to prop up the U.S. banking system is ending. They're talking about the BTFP. We talked about this in the last stream. While a second may be winding down. Some economic commentators fear another banking crisis. So how worried should we be? The red letter day is March 11, when U.S. Central Bank, the Federal Reserve, will end the Bank Term Funding Program, BTFP, a year after it began in response to the failures of regional banks, Signature, Silvergate, and Silicon Valley. These banks were brought down by customers withdrawing deposits en masse, what's called a bank run, both because many were tech or crypto businesses that needed money to recover losses, and because there were better savings rates available elsewhere. This is another thing for people who have bought into the thing that housing prices are going to stay high forever. No, when investors who bought that housing and are sitting on like empty rentals can get better return on investment elsewhere, they will dump those properties and they will go own a piece of paper instead if it gives them a better, return on their investment. Like if you have a rental property that, you wind up, because of how much you had to buy it for and the interest rate on the loan, on the mortgage, and then the prevailing rental rate, if And then you got to actually maintain that. You got to hire somebody to mow the grass and like paint the exterior and all that kind of stuff. You got to manage the property. If that's only getting you 4%, but you can go buy a piece of paper that'll get you 5%, believe me, they're not going to hang on to the building for that long. So, that's going to happen too, something to keep in mind. This damaged the bank's profitability at a time when raised interest rates had already weakened their balance sheets by reducing the value of their holdings in government bonds. Silvergate failed first, but Silicon Valley Bank's collapse on March 10 was particularly memorable. It triggered a bank run by announcing that it needed to raise capital after being forced to sell bonds at a loss. There soon followed the failures of Signature and also Swiss bank Credit Suisse, which had to be taken over by neighboring giant UBS. There had been long-standing problems at Credit Suisse, but heightened anxieties on the Bank of the U.S. upheaval delivered the final blow. How the BTFP works. Investors then feared that other banks would fail. Most U.S. banks were similarly exposed to customer withdrawals and underwater bond portfolios, while the Credit Suisse collapse demonstrated the potential for contagion. So contagion is when it escapes one institution and starts affecting other ones because they do have investments in other institutions. If that goes down, it can sometimes take down other institutions. The Fed's BTFP stopped the panic by allowing U.S. banks to borrow from the central bank using their bonds as collateral. Not only did this let them quietly access more funding, the scheme also priced the bonds at their original face value, not market value. So, I don't know what to say. This effectively negated the interest rate rises and reinflated banks' balance sheets. Only one more bank, San Francisco's First Republic Bank, has since gone under. I mean, it's only been a year, but... And the amount of assets involved in that was also, although the number of institutions was small, the amount of assets was like comparable to what was, starting back in the '08 bubble. So, what will happen as the BTFP closes? I suspect it won't lead to more bank collapses. Banks have had another year to adjust to higher interest rates. Plus, they can still borrow from the Fed through another facility called the discount window, although they don't like going to that because it doesn't look good. Nonetheless, the BTFP's closure is likely to increase banks' borrowing costs, meaning that their profit margins will fall. They might react with higher lending rates or by making credit less available to customers, so making it harder to take out loans or more expensive to take out loans, which is also a way of making it harder, but also just qualifying for the loan will be more difficult, which can potentially weaken the economy, you think? This could combine with a second foreseeable change to create new dangers for the sector. Absolutely. So nobody really knows where this is going, but everybody can see the risk. Quantitative tightening. This is what we were just talking about. That second change relates to the quantitative easing program by the Fed and other central banks, which broadly dates from the global financial crisis of 2007 to 2009. It saw central banks essentially creating new money and using it to buy government bonds and other financial assets. They added more reserves to high street banks as part of this process, enabling these institutions to lend more money as a result. The most recent leg of QE began in March 2020 in response to the pandemic, then ended in 2022 when central banks began a reverse program called quantitative tightening. This involves selling bonds and other assets and removing the proceeds from the financial system. It should be a drag on the economy, yet the effects have been tempered by a facility known as the Overnight Reverse Repurchase Agreement, or Overnight Reverse Repo. This essentially enables financial institutions to deposit their excess cash overnight with their central bank in exchange for government bonds. They earn extra money at a very low risk, injecting more liquidity into the system. So this is those markets where the repo madness happened. That was where that started. There's the reverse repo and the regular repo. The facility was extremely popular during the period of QE and ultra-low interest rates because these injected so much cash into the system. Its use has been falling since late 2022, since central banks have fewer bonds to lend, while institutions have less money to park overnight. This is actually a big thing. You can find videos on this topic itself about the amount of money that on average is going into the repo markets dwindling over time. And when that dries up entirely, which it probably should in the next few months, there could be another liquidity crisis again. It offsets the need for the Fed to remove bank reserves as part of QT, since the bonds flowing out under that scheme are being partially replaced by bonds flowing in through overnight reverse repo. And a pop-up covered part of this, but only when the reverse repo balance reaches very low levels will the system feel the full effect of QT. So that's the explanation for what we were just reading. I couldn't believe it. I'm like, they're ending quantitative tightening again. This is why, because that liquidity is drying up again, and so they're going to back off the quantitative tightening because they don't want another SVB signature bank crisis. So that's what they're trying to do, is like, as this money in the reverse repo market dwindles, they need to back off and give that some space to breathe. So, I mean, they're getting a little bit more savvy about the predicament that they're in, but, it's like, will something else just break instead? Risky times, and this is the end of the article. Heightened interest rates have already led to the most stringent credit standards and weakest loan demand from consumers and businesses in a long time in the U.S. Meanwhile, banks are dealing with other major challenges, such as the plunge in demand for office space as a result of home working. This has brought the medium-sized New York community bank to the brink in recent weeks. I think I had a community post about that. For instance, the closure of the BTFP and the end of the reverse repo buffer, when that dries up, particularly if they coincide, could clearly make banks even more risk-averse and profit-hungry. The danger is that this all damages the economy to the point that bad debts pile up and we hit another 2008-style liquidity crisis where banks become wary of lending to one another and the weaker ones can't get that credit and they become unviable. The recent geopolitical tensions are an additional danger. If cross-border credit and investments dried up, it might further increase the risks of bad debts and could again hit bond prices, further reducing the value of banks' assets and making their borrowing more expensive. They're on such thin ice here. I just literally am getting like a tightrope walker image in my mind. The Fed and other central banks need to be alert to these rising risks. Ice is getting thin here, and get ready to end QT in the near future. The end of the BTFP is unlikely to put banks out of business, and in fact it has been almost a month and nothing major has gone up in flames yet. But it could be one of a series of blows that kicks off a new crisis in the months ahead. So in other words, the reverse repo liquidity, that was one buffer. The BTFP, that's another buffer. As the buffers start to disappear and you're just left with kind of a no guardrail situation, you could get real banged up.